Good day, Doctor. We are from Group Pokemon and now we'll present case study 4. So for question A1, business risk is the danger of insufficient earnings or even losses because of uncertainty or unexpected occurrences. It's anything that jeopardizes a company's ability to generate profits and may affect its long-term sustainability. There are two types of business risk, including pure risk and speculative risk. Business risks are impacted by various factors such as market fluctuation, competition, and natural calamities, and etc. Although organizations cannot eliminate all of the factors that may influence business risk, they may reduce or minimize its impact by employing risk mitigation techniques. For question A2, operating leverage is the percentage of a company's cost structure that is made out of fixed expenses rather than variable costs. Generally, high operating leverages is preferred since even a small percentage change in sales can result in substantial increase in profitability. However, it also indicates that the company is sensitive to strong economic and business cycle changes, resulting in significant business risk. For question B1, financial leverage refers to a firm that uses debt rather than equity to buy assets to improve possible return on investment. A rising debt to asset ratio translates into a greater leverage. Even though the cost of debt can be minimized by using financial leverage, it also involves the risk of overwhelming losses if the adequate returns are not earned to balance the interest expense. On the other hand, financial risk is the risk that a company may be unable to satisfy its debt repayment obligation. Basically, the more a company's debt, the greater its financial risk. A business may face a variety of financial risks, including credit risk, liquidity risk, market risk, and so on. Financial risk management methods are suggested for business to use to reduce the chance of financial risk. For question B2, as mentioned earlier, business risk is the risk of insufficient revenue or even losses because of uncertainty or unanticipated occurrences, while the financial risk is the risk of not being able to repay a loan. Although firms will always face various amount of risk, employing the correct tactic may limit the amount of business and financial risk exposure. For question C, here are the complete values in the income statement for firm L, which are highlighted in green. And here are the complete ratio for firm L. For question C2, the expected ROE for firm U and firm L is 9.0% and 10.8% respectively. Hence, the usage of financial leverage has caused an increase in expected return to shareholders. On the other hand, the business risk for firm U is 2.1%, whereas firm L is 4.2%. This indicates that firm L has double the risk as compared to firm U. Moreover, if the EBIT is equivalent to 2,000, firm U's ROE will be higher than firm L's ROE, where the leverage will have a negative impact on profitability. Nevertheless, if the EBIT is at expected level, then firm L's ROE will be higher than firm U ROE. Lastly, the TIE ratio will be higher when there is no leverage being used, and the TIE ratio will be slightly lower if there is 50% debt used. Thus, the expected TIE will be higher than 2.5 if there are lesser leverage users and will be lower if the debt increases. So for question D1, the optimal capital structure refers to the ideal proportion of both debt and equity financing that a company adopts to minimize its weighted average cost of capital as well as maximizing both its wealth and market values. For this question D, firstly, CDSS must begin by disclosing its plans for recapitalization. Prior to the announcement, the company shares may have some price, which is $20 per share. Then the company will need to estimate the prices that are needed to be paid for the repurchase shares and the strategies that need to be executed for the repurchase of both open market purchases and a tender offer. In this case, we assume that the firm could buy back its shares at the original value of $20. However, most investors would usually reevaluate their perception of the firm's risk and profitability in regard to its new capital structure, which leads to a rise in share prices. Nonetheless, there will be some shareholders that may be concerned with the recapitalization plan that may not go through and opt to sell their shares at the price lower than expected. This means that the share prices will quickly adapt to changes and reach to a new equilibrium that takes the recapitalization plans into account. Finally, CDSS will need to begin with buying shares, then issuing the debt and utilizing the proceeds to pay back the repurchased shares. Hence, CDSS will acquire greater debt but lesser outstanding common shares after their recapitalization plan. The price of the share will eventually settle at its new level once a new earning per share was computed.
Next, for question D3, by applying the formula, the EPS for the $0 debt level is $3 and the TIE is infinity. Meanwhile, the EPS for the $250K debt level is $3.26 with a TIE of 20. The EPS for the $500K debt level is $3.56 with a TIE of 9.09. The EPS for the $750K debt level is $3.86 with a TIE of 5.13. And finally, the EPS for the $1 million debt level is $4.08 with a TIE of 3.13. Then, for question D4, since the payout ratio is 100%, this means that the TPS is actually equal to the EPS. Therefore, if CDSS were recapitalized, we find that the new stock price for each debt level will be $20, $21.03, $21.58, $21.44, and $20.40 respectively. Next, question D5. After looking at the calculation done, we can conclude that the optimal capital structure for CDSS is a debt level of $500K. This is because CDSS was able to achieve the highest stock price of $21.58 at this level of debt compared to other debt levels. As a result, we consider $500K to be the best of those debt considered. For question D6, the answer will be no. The calculation of EPS for each different debt level show that EPS is not maximized at the $500K debt level. Instead, EPS was found to increase gradually with this increase in debt. We can see the EPS is not a very accurate method for making capital structure decision because EPS is not only easily manipulated by corporate decision, but it also does not take into account the different cost of debt and the greater risk that equity holder must take when the incurred debt increases. For question D7, the ideal combination of debt and equity financing that increases market value while lowering a company cost of capital is known as an optimal capital structure. By using this formula, the WACC of the company is 14.03%, indicating that all investments should give a return higher than 14.03%. For question E, regardless of debt level, the firm would be more likely to experience financial trouble if the business risk was higher. Investors would be aware of this, and both cost of debt and cost of capital would turn out to be greater than estimated. Although it is not demonstrated in this analysis, the final result will be a capital structure with the least amount of debt. On the other hand, the lower business risks will result in an optimal capital structure that included more debt. For question F, since it is challenging to evaluate the capital structure decision, managers take the following judgmental consideration into account, which are expected tax rate, asset structure, reserve borrow capacity, and lender agency attitudes. For the last question, question G, the assumption underlying the asymmetric information concept is that investors get signal from management choice of funding. Business with lucrative investment prospect would often finance with debt since they do not want to share the rewards with the new shareholder. In contrast, companies with booming future would prefer equity financing. Investors were aware of this, so when a major established company announces a stock offering, they interpret it as negative news, which caused the stock price to fall. Because of this, business make an effort to avoid having to issue new common stock. This entails keeping some borrowing capacity on hand so that when lucrative investment opportunity arise, they may be financed with debt. That's all for us. Thank you.